Guys, welcome back to Zodiac Trading. So today we're going to look at the Fed hike and the coming recession of the global recession. So we're going to look at how the current Fed hike situation is going to impact the future upcoming recession. First of all, we have to look at the Fed hike because I used to talk about the Fed hike in my previous videos because I had a prediction of that Fed hike is going to be raising rates at 25 basis point, and right now, yesterday night, the Fed actually hikes by quarter point, which is 25 basis point, which is exactly the same as my previous prediction. And right now, I'm anticipating the Fed is going to pulse right there and then stop raising rates for some time. And I don't believe that Fed is going to reduce the interest rate or going to lower the interest rate any sooner. Okay. And there are three reasons why I don't believe that's going to happen. First, I believe the Fed top priority is still taming that inflation. So the reason why Fed is going to tame that inflation is because that inflation is going to fuel the economy system and is going to bring a lot of negative impact, especially on the demand side of the economy. You are going to see, skyrocketing energy price. You're going to see commodity prices going up. You're going to see a lot of wage go up. Basically, you're going to see all sorts of goods and cost would just spike. So from that perspective, the Fed is going to tame that inflation. And I don't see how Fed is going to stop taming inflation, only because to maintain so-called financial stability. Second, the reason why I don't believe Fed is going to lower interest rate for Wall Street banks is because right now I see a lot of institutional traders that they are quite fond of a theory of how Wall Street financial institutions are forcing the Fed to stop raising interest rate because the banks are having significant problem right now because of several reasons. Yes, we are in one of the biggest banking crisis ever happened ever since 2008. And I believe there are several reasons for that. First reason is because the huge banking mismanagement thing. The banking seniors and also executives fail to foresee the risk of raising interest rate, and most of them, they are very stubborn. They are very reluctant to believe that the Fed is going to have a rate hiking instead of Fed lowering its interest rate. They believe that QE will be back soon, and the liquidity injection will resume after a short period of time raising interest rate. And also because of the traders are not hedging the rising interest rate risk well, because interviewed a lot of sell side FRCC traders. Most of them fail to hedge the rising interest rate risk. Part of the reason is because we had a 20-year, maybe 30 years of it's more like 20 years of good QE old days. So it just kind of get all these institutions complacent. Easy money, easy environment. Right now, everything has changed. So that's why you have a banking crisis, because of the serious mismanagement of banks. And second reason why you have a banking crisis mostly because of the liquidity crisis, because there are severe liquidity issues, because a lot of depositors are afraid of having their assets or maybe deposits locked in the bank They are not going to get higher interest rate return out of because you have 5.25% of interest rate, and you have to make that amount of money at least. You have to get a yield higher than that. So that's why a lot of depositors take out their money and invest. Maybe they are longing some repo fund, they are longing some other vehicles that are providing higher yield compared to the Fed fund rate. So that is the reason why a lot of depositors are withdrawing their money out of the bank. So in that case, we can see how SVB and FRC banks, they are receiving constant impact out of the crazy bank run from individuals and from the depositors. And the reason because they have, especially for the SVB case, they have more of centralized. Their depositors are bigger, way larger, and they are very centralized. So you have a huge centralized risk. And in the same time, because the banks are obliged, the SVB is obliged to give back their money, so they have to sell their assets. And their assets are mostly locked in securities, long-term bonds, maybe real estate, etc. So what happened is they have made bad financial decisions. They made bad decisions that they decided to simply put the money in a long-term bond and long-term yield kind of products. They have to sell it with discount price. They have to sell it by causing market losses because the inflation is damaging the yields of the bonds. So they are losing money in the financial market, and they have to pay their customer back. And that's why they are running out of liquidity. So that is essentially that's what happened with the SVB and FRC. To be honest, FRC is a fundamentally good quality banks. From quality perspective, I think it's kind of better than SVB. It's not larger than SVB, but I can see how FRC is quite competitive compared to when you consider its business model. So I believe the current banking crisis is more of a liquidity side. So I don't see in the recent times, I can see how this liquidity crisis will continue, and I can see how depositors will run and put their money in the significantly larger banks. But I don't see the fact that we are having a credit crunch. We're not going to see what happened in 2008. We're not going to see derivative blow up, and we're not going to see that. But what we're going to see is we're going to see some insurance company running out of cash, which I will explain in the next video. And the last reason that I don't see Fed lowering interest rate is that because I don't think in the finance sector the Fed is quite unprepared. Yes, Fed has made a mistake, because Fed has made a mistake by not raising the rate as fast as they could and as strong as they could. That's what I believe when I said the Fed is making a significant mistake, because the Fed is not brave enough. But then the Fed continue to raise interest rate. That I think is the right thing to do. But in the same time, the Fed has also made some mistakes. Some mistakes are very severe. Some mistakes are just small. Okay, but generally speaking, I would just say I will grade the Powell Fed is around. I would just give it a B. Right. I'm not going to give an A plus. I would just give a B. Just an average. The Fed what an average Fed should do. And right now, I believe that the Fed is making severe mistakes because the Fed did not prepare that liquidity window before the banking crisis and the bank run. Okay, so the Fed actually foresee it's going to continue to create stress and pressure to the banking sector, but the Fed and the FDIC are they're just respond to the crisis. They are not prepared for the incoming crisis in the forehead. So that's why I believe Fed is making a huge mistake. If the Fed is going to lower interest rate, and then the Fed, I believe, is going to make an even bigger mistake. So I don't think the Fed is going to lower interest rate any sooner, because if the Fed lowers the rate very quickly, and that would just create another trigger out of inflation. So the inflation is going to be more resilient, and that inflation is going to drop to the bottom, hopefully by around 4.5%, and then quickly bounce back. And if that inflation comes back, it's going to be more resilient, it's going to be stronger. So I don't think FOMC right now, if the Fed lower interest rate, would be a good decision to make. So based on the three reasons above, that I believe we're not going to see a Fed lowering interest rate any faster and any sooner. And I don't really foresee how Fed is going to raising interest rate in the current condition, because it would just destroy the financial the insurer of the financial sector, based on what happened recently. And then let's just move on to the recession sector. Let's just move on to the recession topic. That I believe right now we are very close to a technical recession, because what we can see from the job market data, and I'm going to cover more of job market data in the next video. So because if you are like economy expert, something like that, you will just do a lot of research on the job market, because the job market, just like bond market, it will just give you a lot of signs, a lot of good signals that would just, for traders, they are good signals, good trading signals, good investing signals to pick up. And to do that, it would just take years of experience, tens of years of experience. So here I believe we are reaching the very bad job data, and we are going to see more vacancies we're going to see job vacancies going up. We're going to see the ordinary low income kind of paid job, you have more vacancies, but in the same time, we're going to see how technology company and high payment kind of job opportunity just shrink. So this is what went wrong with the current job data thing, because it kind of just gives you a brief idea of the total amount of the jobs supply. The data doesn't give you an overview of the structure of the job. So you probably end up having more McDonald's and Burger King kind of low paid jobs compared to Goldman Sachs banker job, or maybe a software engineer, or maybe a program engineer at Facebook and Meta and the Alpha Group OpenAI, right? So what you're going to see is that the high-end job opportunity shrink, in the same time the lower paid job opportunity increase, which I will explain in my next video. So thank you guys for watching my content. If you like the content, you can join the Patreon. You can subscribe and share my content, because if you do, I would be really appreciate, and I will just share more of my insights to you. So thank you guys for watching. I will see you in next episode. Goodbye.